Hello everyone, welcome back. Alright, welcome back to the next video. Right, in this video we're going to talk about the more important ratio, which is the debt to cash flow ratio. Okay, now if you like all my videos thus far, if you think it has helped you in a very small little way, please like and subscribe. Alright, like and subscribe. Okay, now in this channel I will talk about all kinds of knowledge. Alright, but more importantly, I'm gonna talk about why you need to be an expert, why you need to be a trainer. Now that is in the video series called Be a Power Giver. Okay, but in any case, if you're not looking to be a trainer or a coach, you just want to gain some knowledge on the capital markets, you are at the right video series, which is Stocks 101 for beginners. Right, now today we're gonna talk about this ratio called debt to cash flow. In the last video we talked about debt to equity. Okay, but in this video we're going to talk about debt to cash flow. Now the debt to cash flow ratio basically, alright, is actually, to me, in my opinion, it's a more important ratio as compared to debt to equity, right? And the reason for that is because debt to cash flow is a more I wouldn't use the word current ratio, because the word current ratio is actually a type of ratio by itself, but the debt to cash flow ratio is actually more recent, and it's a much more updated ratio. It's a much more impactful ratio as compared to the debt to equity ratio. So what is the formula for cash flow to debt, alright, or debt to cash flow? Alright, the debt to cash flow ratio, okay, is basically the formula for this ratio is basically cash flow, alright, from operations divided by total debt. Right, total cash flow from operations divided by total debt. Now I think most of the words there are self-explanatory. Perhaps the only word that you might want to clarify with me, or you might find a bit more unclear, will be from ops. Right, so what exactly does this mean? Okay, from operations basically refers to every single penny that is required to run the company, produce the product, do the R&D of the company, the marketing. Basically every single dollar that is spent by the company is considered operations expenses. Right, even if that money is spent to acquire a customer, even if the money is spent for marketing purposes, even if the money is spent on sponsorships, even if the money is spent on charity, it all is considered operations. Okay, of course, if it's charity, in terms of tax, it will play a part, right? In terms of, from a taxation point of view, if you are using company money to do charity, then you might be actually saved some tax, right? That is the way that some companies actually use to cut down on the amount of tax that they pay. But from an operations standpoint, even if you use the money for charity, we still count it into cash flow for operations, right? Now there is another word when it comes to cash flow, and that is free cash flow. All right, there is free cash flow, and then there is cash flow from operations. Now, what is the difference? All right, what is the difference? Okay, the major difference is that free cash flow will subtract away it subtracts away cash that is used for capital expenditures. Right, so what is capital expenditure? Capital expenditure basically refers to the procurement, the money that is used to procure your equipment, any type of physical asset of the company, alright, physical inventory. Now, but whereas cash flow from ops does not subtract away cash that was used for capital expenditure, right? So cash flow from ops is actually a bigger concept as compared to free cash flow. All right, the idea of free cash flow means money that you can use straight, that you can use as of now. That's why it subtracts away the money that was used to buy the capital equipment. Whereas cash flow from operations includes that amount of money that you used for capital expenditure. Now, what is the difference here? Free cash flow could be a better numerator, could be a better variable that is used in the formula instead of cash flow from operations, because free cash flow is truly money that you can use right now. If I want to use the money from the money that I spent on buying equipment, I would have to sell the equipment away to convert it into cash. So that would take time, and there is a certain degree of depreciation involved, right? Second-hand goods as compared to first-hand goods will definitely be valued lesser. All right, so if you want to be really strict, you can actually go for the debt to free cash flow ratio, right? And definitely the ratio will be worst. Right? So for example, if the amount of debt that the company has incurred is 1 million, all right, let's say USD, okay, and the amount of cash flow you have from operations, including the money that was used to purchase capital equipment, is 1 million USD as well, then your debt to cash flow ratio will be 1 million divided by 1 million, which is 1, right? But instead, let's say you don't want to use cash flow from operations as the denominator. You want to use free cash flow as the denominator. Now that will give a very different picture, because now you cannot include the money that was used to buy capital equipment. You can't include the amount of money, so your amount of money becomes lesser. So maybe you use a good 500,000 to buy capital equipment, so you're left with 500,000. If you want to use free cash flow as a denominator. Now 1 million divided by 500,000 is 0.5. Sorry, it's 2. So now your cash flow, your debt to free cash flow ratio is 2. So it's a whopping 100% jump, right? 200% jump, sorry, not 100%, 200%, right? So, and it matters because for most market standards, the danger zone is always at 2. The moment your debt to cash flow ratio, whether it's free cash flow or cash flow from operations, hits the magic 2, then experts, right, analysts would start to take notice and say that this company is or could be facing cash flow issues. All right, but that is just a general rule of thumb. Okay, general rule of thumb. At the end of the day, you still have to look at this thing called the industry average. Basically, you have to see what is the norm for this industry, right, in terms of cash flow, right? Because certain industries, their cash flow might be slower, and certain industries, their cash flow might be faster, right? For example, your fast-moving consumer goods industry, right? That industry, your cash flow will be very healthy because you buy, you put it on the shelf, you sell, you buy, you sell, you buy, you sell, and between the buying and the selling, the time taken is minimal, right? People just take it out of the shelf and then buy. So your cash flow could be healthier. But whereas in other industries, maybe you sell today, like for example, digital marketing or maybe your advertisement industry, right? Advertising industry, maybe you sell the ads today, but by the time the customer pays you, could be 3 or 4 months down the road. So your cash flow is not that good, all right? So it all, at the end of the day, it comes down to industry average. So make sure you check the industry average of the debt to free cash flow ratio or the debt to cash flow ratio, cash flow from operations ratio. All right, so that's it for this lesson. Thank you very much. My name is Jefford Lim from Rubik's Academy. Subscribe if you like this video. All right, download our app if you want to find the trainer, the lesson, the tutor of your dreams. All right, thank you very much. My name is Jefford, signing out.